The initial balance breakout has a 97% chance of happening. In this video, I'm going to break down exactly how I've been using that statistic to just print money on futures. What is going on, guys? Mr. Zink here. Jumping right into it, the initial balance breakout is the first 60 minutes of market open. As most of you know, I like to trade on the 15-minute time frame, so that is the first 4 15-minute candles. The high or low made in that time frame gives you the initial balance. What you do with this concept is you're looking for the break of the high or low, and this has a 97% chance of happening. If we go over to Edgeful and view the data, 74.6% of the time it is only going to break one of those levels. 23.02% of the time it's going to break two of those levels, the high and the low, and only 2.38% of the time it is not going to break either. Looking at this chart, looking at the concept here, the high is made from the wick high, the low is made from the wick low. The first 60 minutes, it has a 3% chance of staying inside that range. So if that happens, if the high is, let's say, 570 and the low is 565, you have a 3% chance that price will consolidate within that $5 range for the rest of the trading day. If that happens, close the charts, sayonara, no need to trade during that chop. Now, the concept itself is taking advantage of that 97% statistic. I don't care if it's a single break or a double break, because that is a trading strategy on its own. What I care about is the possibility of a no break. Inversing that 2.38%, that means that it's a 97.62% chance of having a break of one of those levels. In this case, we're looking for a break of the high. Our entry is, let's say, 20 to 30 points away from the high. We put a reasonable stop loss in. We move the stop loss up as it gets closer to our take profit. If it hits break even, so be it. But we're taking advantage of the possibility that it's a 97% chance of breaking that high or low. Once that high or low is broken, it's only a 24% chance to go and break the opposing side. In this case, we're looking for a break of the high. There's only a 24% chance to break the low. On the other side of that, once the high is broken, it's only a 32% chance to continue to 0.5 standard deviation. We're going to cover exactly what that means coming up shortly. Essentially what this means is once that high or low of the initial balance is broken, there's not really much to do for trading afterwards. Given today's price action, this is our initial balance. We have the 9:30 open and the close of that 10:15 candle, 10:30. That's our initial balance that we were given today. In this case, probably going to gravitate towards the high. So what I did, and we're in replay mode right now, what I did today is I ended up taking longs about 20 points away from that high, and it shot right through it. Now, this is an indicator on TradingView that Edgeful has. If you go and buy Edgeful or get the monthly membership, you get access to all their indicators, and one of them being the initial balance breakout indicator. It gives you the high and low charted automatically for every day of the week as soon as it happens real time. Now, going to this last slide, there's only a 32% chance that price continues to that 0.5 standard deviation. What the standard deviations are is the size of the initial balance. So if the initial balance is $2.50 like it is today, that means that one standard deviation away from that is $2.50 above 570.40, and so on. Half the standard deviation, $1.25. Edgeful also has an indicator for that, and there's the level that we rejected off. Today we happened to hit that 32% chance, and then we ended up reversing and hitting both the 32% chance of hitting 0.5 standard deviation and also going all the way down and hitting a double break, which is only a 24% chance, or in this case 23% chance, back tested for the past 6 months. That's the concept itself. Based on these slides, as soon as we have that level broken, and it's with a wick that could be 1 cent, it could be a wick that's $1. As soon as the high or low of the initial balance is broken, the concept is washed. You're not taking any trades after that. You're not trying to target the initial balance low. You're not trying to retest a bounce off of that initial balance high. Once you hit the initial break, the initial balance breakout, that's the 97% statistic. Once that happens, you're no longer looking to go long, you're no longer looking to go short. You're only anticipating the break itself. Now, what happened yesterday, and this one was pretty funny, I took longs at about 10:32, maybe a little bit after, maybe a little bit before, looking for that initial balance high. I had a stop loss at $1,000, moved it up to break even. It got hit at break even. I re-entered. I'll go down to the 5 minute for this. I re-entered on another dip, which happened at 10:30. Stop loss at a negative 1,000. The candle wicked all the way back up. I was up about 1,200, moved the stop loss to $400 in the profit, and then it wicked me out again. You are not blindly taking, or I'm not blindly taking longs when it's within the middle of that range, because it could go either way. Just because it's 97% that it's going to break one of the levels, there are a couple days that happen to not break the level. I'm increasing my odds of having a high or low break by waiting for it to gravitate towards that naturally. Now, on the opposing side of that, we also go and chart our London 50, and that helps with the entries. Our London 50 model we put in at the 4 a.m. high. London low happened to be at 850. We drag that out to the right. Look where price rejected, trying to get back to that initial balance breakout high. Once we got to the low, I took shorts at 1135 because we broke below London low. My take profit was at the initial balance low, and we missed it by a whopping 3 cents. 3 whole cents. So this has yet to break. The initial balance was still intact going into close, and I took longs right before close. I believe I took them at 230, rode them up, managed to get them all the way up to 564.71. I was up $800 in this position, trailed my stop loss to $400 in the profit, got wicked out, and then it proceeded and broke the initial balance high. This can happen. It's a macro data point. It doesn't mean it's going to happen immediately. You're looking for entries along the way. You're looking for other points of confluence, whether it be the London 50 model, whether it be fair value gaps, change in state of delivery, whatever your concept is that you're trading alongside the initial balance breakout, that helps with your entries. This isn't something you just blindly take longs or shorts waiting for it to break out. You're making calculated risk. In this case, what I like to do, give it 20 to 30 points away from the high or low, put a stop loss at negative 1,000, add 2 NQ, 3 NQ. If it goes and hits the high or low, great. If my stop loss hits, I wait for it to get in another setup, wait for it to go target the long, the high, whatever it might be. Now, there are other statistics on Edgeful. You can go and look at reports as in what is the buy rejection. And this one measures if the initial balance low is formed first, this is your percent chance of going and hitting the high. Going back to today's price action, Wednesday, September 3rd. There we go, get rid of that one. We formed the low first. And you can see that we formed the low at 9:45, and then the high was formed at 10:25. The very next candle, the 10:30 candle, ended up breaking it. So this was maybe 2 minutes that I was in the trade for the initial balance high. But this gives you another set of confluence if you're looking to go long or short. This is saying because the low was formed first, 1 out of 5 times the low will get broken first. Whereas 4 out of 5 times, 4 out of 5 trading days of the week, the high will get broken first. We were close to the high. We were within 30 points. 2 points of confluence for me to go long. Long, I believe I was 25 MNQ, so 2.5 NQ, and then 2 NQ. 2 trades, ended up closing the day at $1,500. Yes, these are combines for now, but we were testing the concept. Now that I'm going to pass these combines after this $1,500 day, we're going to deploy the strategy with the same sizing that we did on the combines, same stop loss, same concept, using the data backed by Edgeful. That's a quick breakdown of how I've been using the initial balance breakout. Again, for today's example, once we broke that initial balance, I'm no longer looking to trade today. So I don't care if it was a double break. I don't care if it was a single break. I don't care if price reverses all the way back up, breaks it for a third time. My trade was at 1030 once the initial high was broken. No more trades after that. Make our money, get out of the market, go do some projects, whatever I want to do for the rest of the day. Hope you enjoyed this video. If you want some more of these, drop a comment. Make sure you like and subscribe. I'll post another video on just a recap of this concept later this week. See you guys later.